Okay, good morning, everybody. Thanks again for joining us this morning for another installment of the Prestige series of COVID webinars. My name is Jason Flynn. Again, I'm the Director of Human Resources and Client Services here at Prestige Employee Administrators. Today, back with us again is our Tax Manager, Carol Sawyer. And again, we have Andy Lubash with us to speak about to make some introductions, to talk about some updates. It's certainly nice to have him again, as always, on these calls. You know, as I've mentioned in the past webinars, Andy Lubash has been involved with NAPIO for many years and is actually the current chairperson. So it's always a nice insight to have from Andy on these calls with some inside information about what's going on out in the world today, more so than we'd get out there on the television or on the internet. And again, Seth Peretta will also be joining us. He is a principal at Groom Law Group, and he seems to be a mainstay with us with these webinars. Again, it's really nice to have Seth's insight on these calls as he's been taking us through the loan forgiveness application process and some other legal updates. So as for the updates for today's webinar, Andy and Seth will be kicking things off this morning with some legal updates. I know everyone's chomping at the bit to find out what's been going on the inside track here on Capitol Hill and with all these different regulations. So it's nice to be able to have some insight to be able to provide to everybody on this call. So again, the focus today will revolve mostly around the loan forgiveness details. Seth will be specifically getting into some legislative developments as well as part 3 of the Paycheck Protection Program loan forgiveness application process that he's been guiding us on for the past few weeks. After Seth's guidance, we'll wrap up with a question and answer session, which again includes many of the questions that have come from our very own webinar attendees and clients here at Prestige. So again, thank you for sending over this information and these questions to us. Definitely helps to educate everyone else out there. As a reminder, all participants will be muted throughout the webinar. However, if you do have a question, I urge you to use the Q&A feature within the webinar and direct the question to the panelists. We will do our best to answer all of the incoming questions, and a copy of the presentation will be available on the COVID Resource Center within the Prestige website following the webinar. So at this point, what I'd like to do is hand the reins over to Andy Lubash. Andy, take it away.
And again, thank you everybody for taking time out of your busy schedules to attend these webinars. Again, we hope that you find them very informative and useful. It just seems like every week one thing changes from the week before. But again, this week I don't think we've seen many changes. I guess due to world events right now, the focus is not really on PPP and coronavirus. So again, a lot going on in the world right now. So again, a lot more questions coming in regarding other issues as well. So again, I want to reiterate that we are here for that. This is a very difficult time for all of us. And again, we are here to help regardless what the question is regarding. So again, we are not here just for PPP and coronavirus. Again, Seth will continue with the last I guess I don't think it is the last segment of the PPP forgiveness application. Again, for those that weren't here last week, the Flexibility Act was passed by both the House and the Senate. Some rules have changed. Some rules, believe it or not, even with the passage of the Flexibility Act, are confusing. And there are no answers. And there's hopefully going to be some guidance forthcoming to some of the questions that some of you have been asking. So instead of just sitting here and hogging up the time and sucking all the air out of the room, I want to turn it over to Seth. Again, thank you everybody for attending. Any questions, like I said, I am here. My direct 917-258-0223, and my email is alubash@prestigepeo.com. So again, some of you have asked questions. I've done my best to answer them or direct them into the place that I can get them answered and get back to you. But again, I just want to reiterate, we are here for you. Again, any questions regarding, I guess, anything. So, all right, Seth, you're on. I'll be quiet. Everybody applaud. Okay, then I'm being quiet. And go ahead, Seth.
All right. Thanks a lot, Andy. So we had planned, for this week to be part 3 of 3, that by the time you got to the end of the process, you'd have a really good idea of exactly what was going to be required. Haha, surprise, Congress had a different idea. We're going to talk about the Paycheck Protection Program Flexibility Act, or PPPFA. It is now law, as Andy mentioned. It is going to change aspects of the loan application process for probably many of you, if not all of you. So we're going to walk through very high level, perhaps maybe next week or a week thereafter. Prestige will provide, I think, even more detail on the potential changes that could be at play for you based on the passage of this new law. We are going to walk through the general provisions in that law very quickly to give folks a sort of an overview of what has changed or how those rules have been liberalized. We're also going to talk about the joint statement from SBA and Treasury that was issued just a couple of days ago regarding this new law, the Flexibility Act. We'll talk about two important two important discussion points in that joint statement. It does give us a very helpful insight into where Treasury and SBA is heading on two sort of pretty important issues. And then we're going to actually do what we thought we were always going to do today, which is complete part 3 of our 3-part series, which is we're actually going to fill out the actual loan forgiveness application, having done the worksheet and the Schedule A. When we get to the end of today's webinar, we will have completed the application in its current form. But as we're going to talk about just in a moment or two, this application is going to change in light of the Flexibility Act having passed. And so we're going to complete it based on the law that was in effect, when we started this process. I will try to highlight for you where there may be some changes to the application in light of the enactment of the Flexibility Act. But, you should expect that the general principles, the way we went around calculating things, the information that's being considered and looked at on the application, all of that's going to stay the same. There is some changes to perhaps the duration of the covered period that you're looking at for when you calculate your forgivable expenses, etc. So the application will change, but the core fundamental concepts we've been talking about these last 3 weeks will remain the same. All right, in terms of that new piece of legislation on the next slide, there we go. The act, as I think we talked about last week, was initially passed by the House on May 28th. That's the House of Representatives. The other chamber of Congress, the Senate, it looked like they were going to pass their own bill. Several senators had proposed their own bill. There was also some concern by the Senate that there was language in the House-passed version that would have created a very unfortunate potential, which is, as we've talked about the last couple of weeks, there's something called the 75-25 rule, which is that you have to use 75% of your proceeds on eligible payroll costs. And that was created by SBA Treasury. They did also, for purposes of a loan application, limit the amount of forgiveness to an amount that is comprised of 75% of payroll costs. So if you fail to utilize 75% of your proceeds on eligible payroll costs, they did still, under their rules, allow you to get an amount forgiven. It's just that 75% of that amount had to be payroll costs. So if you, instead of spending 75 cents of a dollar on payroll, you spent 50 cents, you didn't actually meet the use requirement, but SBA and Treasury were allowing you to still get forgiveness, but that 50 cents that you spent on payroll would have to be 75% of the overall forgiveness amount. The language in the House bill was concerning because it arguably could have said that if you didn't actually use 60% of your loan on eligible payroll costs, your forgiveness amount would be zero. And so because of that concern, the general thought was the Senate was going to propose its own bill with language that eliminated that concern. However, because the House had gone on recess to the end of June, there was some concern that they needed to enact something quickly. And so the Senate voted unexpectedly the middle of last week, actually after our webinar, to pass the House version of the bill, and the president signed it into law on Friday morning. The next slide outlines the significant provisions of that act. One is that for loans that began on June 5th or thereafter, the loan term is going to be extended to a minimum of 5 years and a maximum of 10. As you may recall, for existing loans, those have a 2-year term maximum. Existing loans will not change. This is just for new loans issued after June 5th. As you guys may also recall, premium payments, principal payments, interest on those principal payments, and lender fees are generally deferred for 6 months under Treasury SBA rules. This act will extend the deferral period basically until you seek forgiveness, or if you don't seek forgiveness, until 10 months after the close of your loan forgiveness covered period. So deferral really, there's no reason really why you should ever have to pay interest, principal payments, or fees on the forgiveness amounts under the new law. Very importantly, there was concern that people were not going to have sufficient time to use up their expenses. So the Flexibility Act allows borrowers to either use the existing 8-week loan forgiveness period that we've been talking about for the last 3 weeks, or they can elect to use an alternative covered period, which is equal to basically 24 weeks or December 31st if you hit December 31st before you get to the end of that 24-week period. This rule is going to basically ensure that people have sufficient eligible payroll costs and other costs to try to maximize loan forgiveness, as well as to use the loan proceeds. There are a host of questions that flow from this new choice element, which is, let's say I don't want to use my 8-week loan forgiveness covered period that I originally am allowed because I haven't been able to maximize the extent of payroll costs to maximize my forgivable amount. So I want to use the alternative covered period. Let's say I end up spending all of my proceeds and maximizing my forgiveness amount by week 12. Can I apply for forgiveness at the end of week 12, or do I need to wait until the end of the 24 weeks? We don't know. Interestingly, the statute, for purposes of looking at FTE reduction and salary hourly wage reduction, looks at the full 24 weeks, it appears. It also ties the safe harbors that we've talked about to, instead of using a June 30 date, it now uses a December 31 date. So if I elect to use the alternative covered period and go beyond that 8-week period, do I have to maintain headcount and salary and hourly wages for the full duration of that 24-week period? If I want to use the safe harbor, do I need to look at headcount and whether I've restored wages on December 31st, or can I look at it when I seek forgiveness? Lots of questions have come from this provision. Unfortunately, we do not know the answer. As I just mentioned, SBA and Treasury had proposed a 75% use and forgiveness requirement, which was effectively that you had to spend 75% of your loan proceeds on payroll costs. The statute effectively replaces that 75% requirement with a 60% requirement. So you only need to spend 60% of your loan proceeds on payroll costs. And as we're going to talk about, we believe Treasury and SBA have interpreted the statutory language in a favorable way to allow borrowers to obtain forgiveness even if they were to fail to hit that 60% use requirement. As I mentioned, the two safe harbors, the FTE reduction safe harbor and salary hourly wage reduction safe harbor, now use a 12/31/20 date. As I mentioned, what about if you want to try to seek forgiveness sooner? Can you utilize those safe harbors? Appears not, but maybe we'll get some helpful guidance. What about folks who are keeping that 8-week loan forgiveness period? They're not using the alternative period. Do they look at June 30th, like we've been talking about for the last couple of weeks, or do they need to worry about 12/31? We are assuming that SBA and Treasury are going to say you can use that 6/30 date if you're using the 8-week original loan forgiveness covered period, but it's not entirely clear. It also provides an exception. Remember, we walked through those FTE reduction exceptions for folks who voluntarily resign, voluntarily request a reduction in their hours, who are fired for cause, where you make an offer to rehire and it's turned down. Well, the statute includes its own exception. Unfortunately, we don't understand whether this is going to preempt those other exceptions or whether this is going to be additive. We are certainly hoping it's additive, and that just becomes another way in which borrowers can seek to maintain optimal forgiveness amounts. The last thing the Act does, and this is really helpful, is it says no matter when you seek forgiveness or get forgiveness on your PPP loan, you can always defer the employer share of payroll taxes that is otherwise available under the CARES Act. As many of you may recall, the statute said if you get forgiveness, you can't take advantage of the payroll tax deferral provision in the CARES Act, which allows you to defer 50% of your payroll taxes from 2020 through the end of 2021, with the remaining 50% deferred through the end of 2022. Treasury and SBA came out and said, well, actually, you can defer it up until you get your forgiveness. But once you get your forgiveness, you can't defer anymore. The Flexibility Act says, don't worry, you can get forgiveness and you can always still use the full opportunity to defer. So it doesn't matter when you get forgiveness or if you get forgiveness, you're treated just like any other employer for purposes of that payroll tax deferral. So there's a lot here in this act. As I mentioned, it is going to give you the ability to potentially spend more time to incur qualifying expenses, to use up your loan proceeds, and as well to use them to maximize your forgiveness. Soon after the enactment of the act on June 8th, so I believe that was, that will be Monday, there was a joint statement by Treasury and SBA. On the next slide here, we're going to highlight one very important aspect of that joint statement, which is, as I mentioned, there was this 60% rule in the Flexibility Act. This replaces the 75% rule that SBA and Treasury had created in their IFR. As mentioned, there was a lot of concern about how this rule was going to be construed. Currently, under the SBA Treasury guidance, even if I don't use 75% of my loan proceeds on payroll costs, I can still get amounts forgiven. It's just based on whatever payroll costs I had, they must be 75% of what I end up getting forgiven. We were certainly hoping that we would see a similar interpretation by SBA and Treasury with respect to the 60% substitution from the Flexibility Act. In the joint statement, as referenced on the next slide, they have indicated that they will, where it says, if a borrower uses less than 60% of the loan amount for payroll costs during the forgiveness covered period, the borrower will continue to be eligible for partial loan forgiveness, subject to at least 60% of the loan forgiveness amount having been used for payroll costs. So what they're saying is that is basically of the amount that you can have forgiven, at least 60% of that has to be related to payroll. So we believe, as shown on the next slide, that really what they're doing is they are taking their current interpretation of their own 75% rule and just replacing 75% with 60%. So here is an example, right? Acmeco has $1 million loan. They spend 55% of that loan, or $550,000 on payroll costs. They also spend $400,000 on qualifying other non-payroll costs. Under the current rule from SBA and Treasury that was using the 75% threshold, they did not meet the 75% use requirement because they didn't spend 75% of $1 million on payroll. But they were allowed to seek forgiveness, but that $550,000 had to be equal to 75% of their forgivable amount. So you take $550,000 divided by 75.75, and you get a maximum loan forgiveness amount under the IRS SBA, under the Treasury SBA rule of $733,000 and change. Now, we believe that the way this will work with the 60% rule is you're going to do the exact same process, but we would divide $550,000 by 0.60, resulting in a maximum forgivable amount of $916,000 and change. So as you can see there, it's a much more favorable rule for the borrowers using that 60% figure rather than the 75% figure. The one other thing we want to highlight in the joint statement is that notwithstanding the statutory language, as shown on the next slide, the statutory language would suggest you could get a loan, assuming amounts remain available, through the end of 2020. The SBA and Treasury in their joint statement indicated that you will only be able to get a loan through the end of June 30th. So if you have yet to get a PPP loan and want to get one, you need to get it by June 30th, it appears. We've gotten questions about, well, can I get more loans, or can I go get another loan, or can I increase my loan amount now that I have more time to sort of incur expenses? Unfortunately, right now, it appears you can still only have one loan. And so if you've gotten your loan, that's your loan. And the ability to go back and get more money appears not to be available, nor is the availability there to get a second loan. Okay, so now we're back to where I thought I was going to be at the end of last week's session, which is to talk about our case study. Again, we are doing this based on the rules sort of in effect before the Flexibility Act and as reflected in the loan application materials. Treasury and SBA have indicated they will be issuing new revised loan application materials. We would expect these forms to be modified, but to look very, very similar. And so again, the principles and concepts we have talked about up until today should remain the same. As you may recall, we started off by looking at that document number 3, the worksheet. Remember Table 1 and Table 2. Then last week, we filled out document 2 there, the Schedule A. And now we're going to focus on the loan application form today, document number 1. To refresh on our case study, the next slide, we have our company, Acme Co., their owner-employee Brooks in stock. You may recall we have 5 employees that we focused on. Remember, we had Paul P. Phillips, Cora, and Fau. Those 3 were listed on Table 1. Noah Swab was on Table 2. Cirology wasn't on any table because he didn't provide any services during the alternative covered payroll period. We had a PPP loan amount of $90K. The disbursement date was April 15th. And because they used the biweekly payroll period, remember Acme Co. chose to use the alternative covered payroll period, which began on the first day of their first payroll period after April 15th, rather than the default covered period. All right. Now, as you may recall, we were able to get all the way through Schedule A. Just to sort of reiterate some of these numbers here, right? The first part of Schedule A, there are lines 1, 2, and 3, looks at the Table 1 totals. That's for folks who are making less than $100,000 of annualized comp in 2019. That was Paul, Cora, and Fau. Right? That line 1 is their total eligible cash comp of $29,000, pulled right from box 1 of Table 1. We then had their average FTE scores pulled from box 2 of Table 1. That includes those FTE reduction exceptions that we were able to take advantage of. As you may remember, Fau not only had his hours cut and his salary reduced accordingly, he also was subject to a $1,200 additional reduction in pay that had to get reflected as a salary hourly wage reduction in box 3 of the Table 1, and that's there in line 3 of the Schedule A. We also are pulling for lines 4 and 5 numbers from Table 2 of that worksheet. This is all about Noah Swab. Remember, he had $9,200 of eligible payroll cost, and he had an average FTE score of 0.5. When we got to lines 6, 7, and 8, we had to calculate employer contributions towards health and retirement. as well as the employer share of state and local taxes. That gave us the $700 number in line 6, the $440 number in line 7, and the $152 of state and local taxes in line 8. As you remember, owner employees, self-employed persons, general partners are not listed on tables 1 or tables 2. Remember, we have Burks in stock, our owner employee. She got reflected in line 9 for $15,385 of eligible cash comp. We then, for line 10, added up all of our payroll costs from lines 1, 4, 6, 7, 8, and 9 of the Schedule A. And we ended up with a total of $55,382 of payroll costs. We also then did our full-time equivalency calculation, right? Because as you may recall, our maximum loan amount can be reduced if we've had a headcount reduction. And that gave us in line 13 our FTE reduction quotient of 0.84. So that's where we were at the end of last week. Now we're going to take these numbers and we're going to fill out the actual loan forgiveness application beginning on the next slide. All right, so remember, one application per borrower. If there were 2 affiliated companies and each got their own loan, each company will file its own loan forgiveness application. All right, looking at the top of that form on the next slide, you will see there's just some general sort of demographic data relating to the recipient of the loan. Again, moving to the next slide. All right, there we go. We have the borrower's legal name, Acme Co. We have basically, do they have a DBA or trade name? We put their address, their business EIN. We put their phone, the contact, email address. We have their loan number that came from the SBA and from the lender. We have the lender's loan number. We have the loan amount of $90K, and then we have their loan disbursement date of 4/15/20. Moving on now down the form on the next slide, we are going to look at the number of employees at the time of the application for the loan, at the time of the application for forgiveness. It's not entirely clear why they're asking for this data, but at the time of the application, there were 4 employees. At the time of forgiveness, there were 4 employees. It appears this is not an FTE concept. It's just, did you have a common law employee providing services for you on a full, part-time, seasonal, or other basis at those 2 moments in time? Did they get an EIDL loan, an emergency assistance disaster loan? No, they did not. And then payroll schedule, right? They use a biweekly payroll period, so they check the box there. This is presumably, they're going to be checking this to think about whether you're able to use that alternative covered payroll period. All right, moving down the application here. We now get to the covered period, right? That was the 8-week period that began on April 15th, right? Now, as we talked about, the Flexibility Act allows you to use the 24-week covered period instead of the 8-week period. So we would expect that in light of what happened last week with Congress and the president signing it into law, that you will be able to choose a 24-week covered period, or until December 31st if you don't get to the full 24 weeks. But you have the ability, even under the Flexibility Act, to stick with your 8-week covered period. So here again, we're doing this based on the rules in effect prior to the enactment of the Flexibility Act. So their covered period, their 8-week covered period, is going to run from their date they got the loan amounts disbursed. And that's going to be true for everyone there. But because they used a biweekly payroll period and they chose to use the alternative payroll covered period, they're going to use the 8-week period beginning on the first day of their payroll period that follows getting the loan proceeds. And that's April 19th. So that's their alternative payroll covered period start date, and it ends on June 13th. All right, moving on down to the next slide. This is this section we talked about before. if a borrower received in excess of $2 million of loans, that's based on the amounts dispersed originally, and that takes into consideration amounts received by any affiliates. So if taking all affiliates into account, the borrower received more than $2 million of PPP loans originally, they will need to check this box. This box will result in an automatic audit, at least based on what SBA and Treasury have said. So before you check that box, make sure you have to check that box. All right, moving on now to the next slide. We thought we were done calculating. Ha ha, the joke is on us. As you will see here, we are going to be entering our payroll costs, which is Schedule A, line 10, right? And that was some $55,000. But on lines 2, 3, and 4, we have certain business expenses. These are eligible non-payroll costs for business mortgage interest, business rent or lease payments, and business utility payments. As you will see there from the instructions in the dashed box that we've offset here, generally what you're going to be looking at are mortgage interest payments for mortgages that were in effect on or before February 15th of 2020. Same thing with rent or lease payments. Those would be rental agreements or lease agreements in effect on or before February 15th of 2020, as well as utility payments for utilities that were already in effect by agreement beginning on or before February 15th of 2020. Interestingly, you pick up not only sort of these non-payroll costs that were incurred during the covered period, which is going to be not the alternative payroll covered period, but that default covered period, that April 15th of 2020 through that close late 8-week period. It's going to be based on the loan disbursement date. For those 8 weeks, what business mortgage interest, business rent or lease payments, and business utility payments did you incur, as well as pay? And you'll see there in those bullets down at the bottom, we have a little bit of detail on how you figure out paid or incurred, but generally it's a favorable rule for purposes of the borrower. All right, moving to the next slide, we're going to apply it to Acme Co. here. So let's say Acme Co. has no business mortgage, so they're going to put a 0 in line 2. Right? Let me step back. From line 1, we pulled their payroll costs from Schedule A, line 10 of $55,382. For line 2, they have no business mortgage expense, so they put a 0. However, it does pay $6,083 per month for a lease for office space. That took effect before February 15th. Took effect on January 1, which is on average $200 per day. Thus, remember, they're using the 8-week covered period and it has to begin on the date the loans were dispersed, which is April 15th. So they're going to count 56 days from that date forward. They're going to multiply it by 200, and they're going to show a business rental lease payment on line 3 of the application of $11,200. Acme also had qualifying utility payments of $5 per day for phone, $12 a day on average for electricity, $4 for water, for a total of $1,216. So that goes on line 4. All right, now we moved on to the next slide. So we're really getting close here. We've got 2 lines left we've got really 4 lines left here to complete. As you will see here, for line 8, we are going to take, I need to step back here. We are going to go up to line 5, and we have to enter our total salary hourly wage reduction. As you may recall, remember Fauci had the $1,200 of wage reduction that was not attributable to a reduction in hours. That got reflected on Schedule A, line 3, and that gets pulled into the application here on line 5. So we show $1,200 on line 5. Line 6, as you add the amounts on lines 1, 2, 3, and 4, and you subtract the amount entered on line 5. So if we can back up a couple slides there, Jason, we might be able to actually show lines 1, 2, 3, and 4. There we go, right? 1 is payroll costs. So we add 55,382. We add 0 for business mortgage interest. We add 11,200 for business rent, and then the utility payments of 1216. So we're basically adding up all of our eligible payroll and non-payroll costs in lines 1 through 4 of the application. And then going back to where we were going to subtract line 5, which is that $1,200 salary hourly wage reduction, and we end up at $66,598. So now we've got our sort of amount. We've adjusted it for the salary hourly wage reduction factor, but we need to adjust it now for our FTE reduction factor. So remember, our FTE reduction quotient, which looks at sort of did we maintain headcount, is 0.84. We would love for it to be 1, but it's 0.84. So what we do, and you'll see this down below, potential forgiveness amount. It's going to be the least of lines 8, 9, and 10. So for line 8, for our modified total, which is really the total reflecting our FTE reduction quotient, we take line 6, which is 66,598, and we multiply it by our FTE quotient for a total of 55,942. In theory, we might have been able to get our full PPP loan amount forgiven had we used, basically lots of it on payroll, and that would be 90,000. And as we talked about before, under the rules in effect prior to the enactment of the Flexibility Act, your maximum loan forgivable amount was capped at having to be comprised of 75% of payroll. So if you didn't use 75% on payroll, it didn't cause you to go to 0 on what could be forgiven. It's just that what was forgiven had to be comprised then of at least 75% of payroll. And so you take your line 1, which is basically $90,000, and you divide it by divided by 0.75, and you end up at 73,843. So you take your maximum loan amount and divide it by 0.75, and that gives you your number on line 10, which would be $73,843. So now we have lines 8, 9, and 10 complete, and we're looking at that, and we're so wishing it was $90,000 that we could have forgiven, but sadly, we didn't spend enough money on payroll, right? So you look at line 10. Well, if we, basically looking at how much money we spent on payroll costs, our maximum amount could be $73,843. But sadly, because we had our FTE reduction, and you apply a FTE reduction quotient, we ended up basically at $55,942. So the forgivable amount for Acme is $55,942 of the $90,000. This means that Acme would need to repay the remaining balance of $34,058 at a maximum interest rate of 1% over the 2-year term of the loan. So here we are, we've come to the end. What I want to highlight here is just in light of the passage of the Flexibility Act, a few things to think about. What you see here, right, is that AcmeCo did not spend enough of their loan on eligible payroll costs, right? 73% or 75% of $90,000 is, significantly more than what they spent on eligible payroll costs. So if they were now to say, gosh, I shouldn't seek forgiveness, what I really should do, right, is I should maybe elect the new alternative covered period that I can elect under the Flexibility Act of 24 weeks. And that will give me more time to spend my loan proceeds on qualifying payroll costs. And by doing that, I'm going to maximize my loan forgiveness amount. And as a result, the amount that I show in line 11 on the application will go up. Now, that may mean you have to maintain headcount longer. That may mean you have to maintain salary and hourly wage levels longer. So there may be some cost benefit analysis here. The Flexibility Act really does allow you to maximize your forgivable amount. Also keep in mind here that you see 0.75 on line 10, right? That will become 0.60, we believe, in light of the passage of the Flexibility Act. And so at the end of the day, in order to maximize your loan forgiveness amount, you're only going to really have to be spending 60 cents on the dollar on eligible payroll costs rather than on other eligible non-payroll costs. So it'll be a lower threshold that you'll have to accomplish. We believe that 0.60 threshold will apply whether you stay with the 8-week covered period or you elect that 24-week covered period. But with that, we've come to the end of the 3-part series. I'm going to turn it back to our friends at Prestige and appreciate your time and sticking with us for these 3 weeks. Thank you.
Thank you, Seth. As always, fantastic guidance. We really appreciate it, as I'm sure many on the call do. Questions will come in as they have been, not just today, but throughout the week. And that brings us to where we are right now, which is our frequently asked questions section. You know, we do have a few slides. And again, a lot of these are taken from the questions that come in over the course of last week's webinar and through the week from our clients. So we felt that they were relevant to what people are looking to find the answers on, and we wanted to bring that to everybody today during the call. So I will start off with the first question that everybody sees here on their slide, which is, does the salary/wages, pension contributions, and health insurance premiums for quote-unquote S corporation owner who is paid a salary and receives a W-2 counted as part of payroll costs?
Great question, because there was a bit of a change between the interpretation of the CARES Act, the way it was written, and then what the forgiveness application came forward with. In the application, or in the forgiveness application, there's only one place for owner employees, and that's line 9. Line 6, 7, and 8 on the Schedule A do not have spots for owner benefits that are listed on those lines. So without additional guidance from the SBA, it does not appear that those additional expenses for owner employees, for partners, for self-employed are eligible for forgiveness.
Okay, great. Next question asks, when does the covered period, either 8-week or 24-week, begin?
Covered period begins on the date you receive the money, regardless of whether you applied for the loan in April or you apply for it now. There is, once again, though, that alternate covered period for people that, or for companies that pay on either a weekly or a bi-weekly schedule. They are eligible to pick an 8-week period that begins on the first day of the next pay period. There really isn't a whole lot of benefit necessarily for doing that because, once again, the application was very clear that it is payroll costs that are paid or incurred. So if you're funded for your loan on April 5th and on April 6th, you have a pay date for obviously a pay period from before the loan, that amount is eligible for forgiveness. But to make bookkeeping a little easier, so to speak, they do allow the alternate covered period for just weekly and bi-weekly pay schedules.
All right. On the next slide, the first question asks, I have a part-time employee who is out for the entire 8-week covered period due to surgery. Will this count against the FTE count?
Well, if you'd asked this before PPP-FA, the new guidance or the new law that was enacted, the answer would have been very simple. Yes, the SBA and Treasury added additional language to provide an FTE exception for those employees that voluntarily asked for reduction in hours, regardless of the reason, being out for surgery being one of those. So the answer used to be yes. The PPP-FA did have its own exclusion that it talked about, and we do not know if that supersedes the previous exceptions issued by SBA and Treasury. So stay tuned.
All right, next question asks, if I had 10 FTEs in the look-back period and then have 9.5 FTEs during the covered period, how much will the forgiveness be reduced?
And instead of looking at how much the forgiveness will be reduced, I showed you how to make the calculation of what is eligible. And it's a simple ratio between the FTE in your covered period and the FTE in your look-back period. If it's 9.5 covered period, 10 in the look-back, that's going to give you 95% is eligible for forgiveness.
All right, next slide starts with, can I defer the FICA taxes even if my loan is forgiven?
Yes, this is a change. The prior guidance was you could defer your FICA taxes during your covered period and up until your loan was forgiven. Congress has said, no, we want you to be able to defer your FICA taxes for the entire remainder of 2020. And again, regardless if you had a PPP loan or not, those amounts are due payable at the end of 2021 and the other half due at the end of 2022.
Okay, next we have is, who will be approving the forgiveness applications?
Each individual lender and bank will be approving those applications. So when you have questions or when you think about what you're going to need to submit, think about what your bank asked for in the application process. Unfortunately, the banks weren't all the same. They asked for different things. Some wanted more reports than others. Once again, our reports from Prestige as a third-party administrator and provider should be accepted by your lenders as they were during the application process, but it will be your bank making the yes or no decision on the application and the paperwork.
Great. Next question we have is, how and when do I make the election between 8 and 24 weeks?
We're unsure. We've just learned about the 24-week covered period possibility. I believe it would be a part of the application, the forgiveness application. You would need two different applications, one for 8 weeks and one for 24 weeks, because there'll be different math. But those of you that are approaching the end of your 8 weeks, be patient, wait for the new rules to roll out, continue to spend your money. You can walk through the math as Seth has taken us through the last 3 weeks to determine where you stand at the moment. But we will need to wait for that additional guidance that typically comes from SBA and Treasury on the weekends.
All right, next slide starts off the question that recently came in from a client. And that question asks, for employers that received the PPP loan with the 8-week time frame, do they now get to choose if they follow the 8 weeks or 24 weeks? We are getting to the end of our 8-week period, and moving to 24 weeks wouldn't necessarily help us.
Right, and I kind of discussed this a little bit in the last answer. First of all, I would still say be patient. Do not rush trying to complete the application, because as Seth mentioned, the application we have has a 75-25 ratio, and it's now 60-40. And this has been our guidance all along. Don't rush to submit an application. The funding is there. It's now just you received the funds. It's the forgiveness process. Unlike the application, when everyone was worried about it running out of money, there is no hurry at this point. So yes, you'll be able to choose the either 8 weeks or 24 weeks that benefits your company the most, but we're still waiting to see how that's going to work.
Great, thanks, Carol. The next question asks, regarding the calculation of average FTEs, would adding 1 FTE employee mid-8-week period only count as a half FTE on table 1 of the loan forgiveness application?
That is correct. It is the timing of when those employees come back, because the FTE is, and once again, I'll just currently go with the 8 weeks because we don't have any guidance yet on what SBA and Treasury is going to want for a 24-week period. It is an 8-week average. So if someone comes in halfway through, they work 0 hours for 4 weeks, 40 hours a week for 4 more weeks at the end, that will result in a 0.5 FTE. The FTE calculations are complicated. SBA and Treasury threw us a loop between the CARES Act and the forgiveness application. So be patient. Once again, the purpose of the CARES Act is to get wages in the pockets of American workers. Do your best to do that, and we will work through the process as we go.
Patience, that virtue again. I believe this is the last slide we have with a couple of questions here. If we choose to reduce salaries of full-time employees who make less than $100,000 by the allowable reduction of 25%, we'd still qualify for the forgiveness, but would the forgiveness be reduced?
No, it would not. You're allowed to reduce salaries for people who made less than $100,000 in 2019 up to 25% without losing out on forgiveness. And if you did reduce salary by more than 25%, let's say you did it by 30%, it's only that additional 5% that will reduce your forgiveness, not the full amount.
All right, and the last question we have for today is, if we hire an employee after we receive the PPP loan, but they voluntarily leave the company before the 24 weeks expires, do they count in our headcount number?
Okay, prior to the PPP-FA, the Flexibility Act, there was an exception for employees that voluntarily resigned. The Flexibility Act does provide an additional exception in regards to having someone leave and being unable to replace them. We're going to wait for additional guidance for sure on the answer to this. Based on the application, you would get an exception for this employee. We need to see what SBA and Treasury come out with next.
Excellent. Thank you, Carol. As always. That wraps up our webinar for today. Again, the presentation and the slide deck will be posted on our COVID-19 Resource Center that is located in the Prestige PEO website. I'd urge everyone to visit the COVID Resource Center. There is a phenomenal amount of resources and documentation in there to help guide you through this process. We are currently working on our weekly email update regarding COVID-19 that will be deployed later this week. And please stay tuned for next week's invitation regarding the webinar next Wednesday. As always, you always have your support from HR business partners, payroll, benefits, compliance, your entire support team here at Prestige Employee Administrators, as well as the Prestige mobile app, which will link you directly to your dedicated support teams. Thank you again, everybody, for taking the time to spend with us this morning, and we look forward to speaking with all of you again soon.